When financial systems crack, history always begins the same way, with promises. Politicians hold emergency press conferences, pledge trillions of dollars, and swear that this time they've found the solution. In 2008, that promise was called the Emergency Economic Stabilization Act, better known as TARP, a $700 billion rescue package that was supposed to save the economy. Wall Street called it salvation, Main Street called it theft. But here's the truth. It didn't solve the crisis. It postponed it. It bought 16 years of borrowed time. And now, that time is running out. Back then, the US national debt stood at $10 trillion. Today, it's over $38 trillion and rising by the second. The interest payments alone are now larger than the entire Department of Defense budget. Every day, America borrows money just to pay the interest on the money it already owes. That's not policy, that's a Ponzi scheme with a flag on it. In 2026, when the next financial earthquake hits, there will be no cavalry, no too big to fail, no quick fix, no miracle stimulus. The tools that once saved the system, cutting rates, printing money, issuing debt, are now either spent or suicidal. The question isn't if the collapse comes, it's what happens when it does. Because this time, the house of cards is higher, the cracks are deeper, and the escape routes are gone. In 2008, America stood on the edge of a financial abyss, and then pretended it didn't fall. The Troubled Asset Relief Program, or TARP, was hailed as a masterstroke of economic genius. The Treasury Secretary told Congress that without it, banks would collapse, credit would vanish, and millions would lose their homes. He was right about the danger, but wrong about the cure. What Washington sold as a rescue was really a transfer of losses from the private sector to the public. The government didn't save the system, it nationalized the failure. The $700 billion bailout worked the way morphine works for a dying patient. It dulled the pain, masked the symptoms, and let everyone pretend the patient was recovering. But the disease, reckless debt, and moral hazard kept growing underneath. Wall Street called it stabilization. Economists called it liquidity. Ordinary Americans called it what it was, a robbery in broad daylight. Behind the scenes, the same institutions that caused the crash became even more powerful. JP Morgan Chase, Citigroup, Goldman Sachs, and Bank of America were all declared too big to fail. The message was clear. Risk whatever you want. If it goes wrong, taxpayers will clean it up. The government turned capitalism into a one-way bet. Profit was private, but losses were public. And while politicians took victory laps, the cracks in the system deepened. The Federal Reserve, in its desperation to restart growth, slashed interest rates to zero and began creating money out of nothing. Its balance sheet exploded from $800 billion to nearly $8 trillion over the next decade. The Fed became the buyer of last resort, of government bonds, corporate debt, and even toxic mortgage securities. It stopped being a regulator and became a participant, addicted to the very speculation it was meant to control. Meanwhile, the recovery that followed was an illusion built on cheap credit. Asset prices soared, stocks, housing, crypto, but wages barely moved. The rich got richer, the poor borrowed more, and the middle class disappeared into a fog of debt. Every indicator of inequality exploded, yet the political class called it progress. They pointed to record highs on Wall Street and told Main Street to be grateful. The bailout didn't rebuild the economy, it redefined it. It created a world where markets rise only when money is printed and crash the moment it stops. It taught every CEO, investor, and politician that there are no consequences, only bailouts. It made the system bigger, dumber, and far more fragile. And as the champagne flowed on Wall Street, the foundation of the American economy quietly rotted away. 16 years later, the same structure still stands, taller, riskier, and hollow to its core. The world applauded the 2008 rescue as a triumph of leadership. In reality, it was the most expensive delay in human history. The bleeding never stopped. We just stopped looking at the wound. In 2008, The government still had weapons. The Federal Reserve could slash interest rates to zero. Congress could approve emergency spending. The dollar still commanded faith around the world. When panic hit, policymakers had the room and the credibility to act. But 16 years later, that arsenal is empty. Every tool that saved the system last time has either been exhausted, corrupted, or rendered useless. When the next crisis arrives, and it will, there will be no painless bailout. Interest rates are already high because of the battle against inflation. Cutting them again would mean reigniting the very fire the Fed just spent years trying to extinguish. Printing more money, once seen as a miracle solution, would now destroy what's left of the dollar's credibility. The global market is already flooded with US debt. Investors are growing uneasy. They're demanding higher yields to lend money to Washington, and that demand compounds the very problem it's meant to solve. Back in 2008, America's national debt was about $10 trillion. Today, it has surpassed $38 trillion. The interest payments alone exceed $1 trillion a year, more than the nation spends on defense. Every day, the government borrows just to pay interest on its previous borrowing. That isn't fiscal policy, it's financial cannibalism, the system devouring itself to stay alive. And this time, the world is watching differently. In 2008, foreign creditors, especially China, Japan, and European allies, rushed to buy US bonds, helping to stabilize markets. But the geopolitical landscape has changed. Relations with China have deteriorated. Europe faces its own crises. Emerging economies are no longer dependent on Washington's lead. Global trust in American solvency is slipping. The very investors who financed America's previous rescue are now quietly backing away. To make things worse, the Fed itself is dangerously overleveraged. In 2008, its balance sheet was small enough to absorb shocks. Now, after years of quantitative easing, it holds nearly $8 trillion in assets, much of it long-term debt that loses value as rates rise. The Fed can't sell without causing losses. It can't buy without fueling inflation. It's trapped in the same debt spiral as the government it serves. The supposed firefighter has become part of the blaze. Meanwhile, corporate America has gorged on cheap debt for over a decade. Corporate borrowing now exceeds $12 trillion, with a growing share rated as junk. Companies have borrowed not to innovate or expand, but to buy back their own stock, inflating share prices while hollowing out real value. The moment credit tightens, these balance sheets implode. The result? A chain reaction of defaults that the Fed no longer has the power to contain. Even regional banks, once considered stable and conservative, have been weakened by rising rates. The collapse of Silicon Valley Bank in 2023 was just a glimpse of what's to come. Hundreds of banks hold long-term bonds that have plunged in value, creating hundreds of billions in unrealized losses. If depositors start to panic again, the system will unravel faster than any rescue plan can form. In 2008, policymakers promised reform. They vowed to never let greed and leverage threaten the nation again. Yet today, leverage is higher, the risks are bigger, and the tools are gone. The Fed can't cut, Congress can't spend, the dollar can't be printed without breaking faith. The last time the government bought survival with debt. This time, it's out of credit, out of time, and out of options. Every empire eventually reaches the same point, when the cost of maintaining the illusion of strength outweighs the ability to generate real power. The United States, once the undisputed center of global finance, is now confronting that moment. The problem isn't a single policy or party, it's structural, a system built on debt, dependency, and denial. What began as a temporary fix in 2008 has metastasized into a permanent addiction. The US government now spends more than it earns every single year. It borrows to fund defense, healthcare, pensions, and even the interest on past borrowing. The debt ceiling crises that dominate headlines are not real negotiations. They're theatrical reminders that the empire can no longer live within its means. The Federal Reserve papers over the deficit by creating money out of thin air, buying bonds that no one else wants. This cycle used to take decades. Now, it repeats every fiscal quarter. But debt alone isn't what makes the empire fragile. It's the erosion of faith. Faith in the dollar, in the markets, and in the leadership managing them. In 2008, foreign governments still viewed U.S. Treasury bonds as the ultimate safe haven. Today, even America's allies are quietly hedging against that assumption. China and Russia are building alternative payment systems. The BRICS bloc is promoting trade in non-dollar currencies. Central banks across the world are buying gold at the fastest pace in half a century. Each ton of gold added to their vaults is a vote of no confidence in Washington's paper promises. The petrodollar system, which once ensured that all global oil transactions flowed through U.S. currency, is beginning to crack. Saudi Arabia, the linchpin of that system, has signed energy deals denominated in yuan and euros. These shifts might seem symbolic, but in the financial world, confidence is reality. When nations start settling energy in other currencies, they're not just diversifying, they're preparing for the dollar's decline. At home, the signs of decay are everywhere. The infrastructure that once symbolized American progress is crumbling. Bridges collapse, power grids fail, and major cities operate under constant fiscal strain. Social cohesion, the glue that holds a nation together during hard times, has been eaten away by polarization and inequality. The middle class that stabilized the U.S. economy after every previous crisis is now buried under credit card debt, student loans, and rent payments that consume half their income. Empires fall quietly before they collapse visibly. Rome didn't fall the day the barbarians breached its gates. It fell when its citizens stopped believing in Rome. The same process is now unfolding in slow motion across the American financial landscape. The stock market, once a measure of innovation, has become a casino run by algorithms and insiders. The banking sector, supposedly safer after 2008, is now more concentrated than ever. The top 5 banks control more assets than the top 10 did before the crisis. Risk has not been reduced, it has been centralized. And yet, despite these glaring warnings, the political establishment continues to chant the same mantra. This time, it's different. They say the system is more sophisticated, the tools more advanced, the models more predictive. But the mathematics of collapse do not care about slogans. When debt grows faster than income, when faith erodes faster than policy can restore it, when leaders prioritize optics over solutions, the end becomes inevitable. The American empire isn't facing a single bad year or unlucky cycle. It's facing the bill for decades of arrogance. The reckoning won't come because the world stops believing in America. It will come when America stops believing in itself. For years, economists bragged that the United States had built the most resilient economy in the world. But that resilience was an illusion, a trick made possible only by cheap credit and political denial. Since 2008, America hasn't been creating sustainable growth. It's been creating zombies, companies, banks, and even governments that exist not because they're profitable, but because they're artificially kept alive by debt. The warning signs have been flashing for years. During the pandemic, when businesses should have failed, the Federal Reserve unleashed trillions in emergency loans and bond purchases. Companies that couldn't survive a single quarter on their own balance sheets were suddenly rescued. Airlines, hotel chains, and retailers that were drowning in red ink became the new class of too big to fail. The result was a zombie economy, one where survival depends not on innovation or efficiency, but on political access and central bank generosity. These corporations learned a deadly lesson. Failure is optional, so they borrowed even more, using the cash not to build factories or develop products, but to buy back their own stock, inflating share prices and executive bonuses. The illusion of prosperity continued, even as productivity flatlined and household debt soared. Beneath the glowing market numbers was a country running on borrowed oxygen. The banking system followed the same path. After the 2008 meltdown, small and regional banks were promised stability. Instead, they became ticking time bombs. They bought long-term government bonds when interest rates were near zero, a safe bet that turned toxic the moment rates rose. When Silicon Valley Bank imploded in 2023, it was a preview of what happens when those paper losses become real. Hundreds of banks now sit on hundreds of billions in unrealized losses, and no amount of comforting words from Washington can change the math. Meanwhile, commercial real estate is collapsing. Office towers across major cities stand half empty as remote work reshapes the labor landscape. Retail properties, once bustling, now sit abandoned. These buildings are worth far less than the loans that financed them, and those loans are sitting in the portfolios of the same regional banks already under stress. It's the same pattern: borrowed prosperity followed by unavoidable reckoning. In this environment, risk is no longer isolated. It's systemic. The debt of one sector props up another. The survival of corporations depends on government spending, and government spending depends on the illusion of corporate health. One tremor, a sudden rate hike, a bond default, a panic in the repo market, and the entire system cascades. The tragedy is that most Americans won't see the danger until it's too late. The stock market still looks strong. Politicians still promise growth. The media still sells the myth of recovery. But the truth is unavoidable. America's economy hasn't been alive for years. It's been animated. And when the flow of cheap money finally stops, the zombies will fall, one by one. And this time, no one will be there to resurrect them. Every financial collapse begins quietly. Confidence erodes in whispers long before the screaming starts. In 2008, it took months for fear to spread. In 2026, it will take days, maybe hours. The system is so interconnected, so over-leveraged, that a single spark will ignite the entire structure. It doesn't matter what the trigger is. It could be a major bank failure, a cyber attack, a foreign default, or even a political crisis that shakes investor faith. Once trust breaks, everything unravels. The weakest link will snap first, and that link may well be the repo market, the overnight lending network that keeps global finance alive. When banks stop trusting one another enough to lend cash against collateral, the flow of money freezes. Without liquidity, credit lines vanish, payrolls fail, and trading halts. We saw a glimpse of this in 2019, when the repo market seized up and the Federal Reserve had to intervene with hundreds of billions in emergency lending. That was the dress rehearsal. The next time, there won't be enough liquidity or credibility. As confidence collapses, investors will rush for safety, but the old safe havens won't exist. U.S. Treasury bonds, once the world's ultimate refuge, will be the source of the crisis itself. If foreign holders dump treasuries or demand higher yields, borrowing costs will skyrocket. The government will print money to cover the gap, accelerating inflation and devaluing the dollar. A feedback loop of panic will set in. Higher rates trigger more defaults trigger more selling, and every attempt to intervene only deepens the spiral. When equity markets implode, the losses won't be confined to Wall Street. Pension funds, retirement accounts, insurance portfolios, all of them are built on the same fragile foundation of perpetual growth. As values plummet, millions will see their life savings vanish overnight. Regional banks will face deposit runs. The FDIC's insurance fund, already insufficient, will be overwhelmed within days. The government will be forced to choose between letting banks fail or printing trillions more, both catastrophic outcomes. The international reaction will make things worse. Global trade depends on trust in U.S. credit. Once that faith collapses, capital will flee to whatever assets can't be printed: gold, commodities, real estate, even cryptocurrency. Currencies will fluctuate wildly. Emerging markets tied to the dollar will suffer first, but the contagion will not stop there. Europe, Japan, and Canada, all dependent on U.S. demand and liquidity, will be dragged down in the storm. But perhaps the most dangerous part of this chain reaction isn't economic, it's psychological. In 2008, Despite anger and outrage, Americans still believed the government could fix the problem. In 2026, that faith is gone. After years of inflation, broken promises, and political dysfunction, the public no longer trusts the people in charge. When citizens lose confidence in their leaders and investors lose confidence in their money, there is no policy, no speech, no bailout big enough to restore order. The 2026 collapse won't be defined by numbers. It will be defined by disbelief. By the moment the world realizes that the empire built on debt, faith, and printed money has finally reached the end of the line. And when that realization spreads, the reaction will be instant, not gradual, not partial, but total. When the dust finally settles, America will look like a stranger to itself. The collapse of 2026 won't be just an economic event. It will be a reckoning of identity. The dollar, once the backbone of global finance, will lose its dominance. Nations that spent decades trading in US currency will turn toward regional alliances and commodity-backed systems. The new world order won't be designed in Washington. It will be negotiated in Beijing, Riyadh, and Moscow. The same countries that once bought America's debt will now dictate the terms of its decline. At home, the consequences will be brutal. Millions will lose jobs as corporations default and credit evaporates. Pensions will vanish, social programs will buckle, and entire industries built on leverage will disappear. Inflation will devour savings, deflation will destroy asset values. It will feel like both at once, because it will be both. In the chaos, trust will become the rarest currency of all. The government will try to respond. Price controls, capital restrictions, digital currency experiments, but each solution will tighten the noose further. The American middle class, already stretched to its breaking point, will become collateral damage in a financial war it never asked to fight. Some will adapt, finding opportunity in the ruins. Most will not. The cycle of dependence will finally collapse under its own weight. But history will remember this moment differently, not as the end, but as exposure, the moment the mask came off. The myth of endless rescue will die. The idea that governments can print prosperity, that debt can substitute for productivity, will shatter once and for all. In its place will rise a hard truth that every empire has learned too late. You cannot borrow your way out of decline. And when future generations look back, they won't ask how America fell. They'll ask how so many intelligent people refused to believe it could. Because the warning signs weren't hidden. They were flashing in plain sight, just like they always are, right before history repeats itself. Every era ends the same way, not with a single event, but with a slow, deliberate forgetting of what held it together. America's rise was built on faith. Faith in its currency, its institutions, its ingenuity. But faith is fragile, and once broken, it cannot simply be legislated back into existence. What's coming isn't just a financial collapse. It's a collapse of confidence, the silent realization that the system's promises were never built to last. In 2008, the government saved the markets. In 2020, it saved corporations. But in 2026, there will be no one left to save. The debt is too large, the tools too blunt, and the trust too thin. The rescue playbook has been burned by its own overuse. When the next crisis strikes, the world will see what happens when the empire of paper meets the arithmetic of reality. Because every generation believes it's different until the math proves otherwise. You can delay gravity, but you can't escape it. The countdown to 2026 isn't prophecy, it's simple subtraction. And when the final number hits zero, the illusion that the system can always be saved will vanish, along with everything built upon it.